Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to analyze Google stock. I'm going to explain why I believe Google is still one of the best companies for long-term investing. More importantly, I will explain why I believe Google is still undervalued, even after it has recovered a lot recently, especially after the Trump rally. Before I start, I would like to give you more context. Alphabet or Google stock recently reported very strong earnings that were much better than expected. Specifically, Google's cloud computing business grew nearly 35% compared to 1 year ago. Now, Google Cloud is starting to become a very profitable business. Interestingly, Google stock did not rally much, even after Google reported much better earnings than expected and more cost efficiency going forward. I think there are several reasons. First, investors are very concerned that the US antitrust regulators may force Google to break up its online search and online advertising businesses. In this video, I will explain whether the antitrust regulators will actually break up Google's businesses. Second, the market is concerned that Google will face a lot more competition from OpenAI, Perplexity, and Meta going forward because all these AI companies are making AI search engines that will compete with Google search. I will talk about whether these new AI search engines will take away Google's market share in the upcoming years. Of course, the best time to invest in Google is whenever there's a large market correction, such as in 2022 and early 2023, or whenever there's a lot of fear in the market, because Google is much more undervalued during these periods. If you have been following my channel, you may remember that I made several Google stock analysis videos when Google was much more undervalued before. If you bought Google during these large dips, you will have made very good returns by now. I actually bought more Google shares during the large dip in 2022 and during the large dip about 1 month ago. In this video, I'm going to explain why I believe Google is still a great company for long-term investing. I will talk about why I think Google is still slightly undervalued now. You will learn about these topics in this video. First, I will give you a quick stock portfolio update. Then I will talk about Google's biggest risk to consider, Google's long-term growth prospects in cloud computing and AI, Google stock valuation, and whether I will buy more Google stock going forward. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Google's biggest risk to consider and its long-term growth prospects in AI, let me show you one of my stock portfolios so you will know my investing strategies over time. This portfolio is separated into 3 different accounts. This is the first account. You can see that I have invested in several outstanding companies such as MasterCard, Microsoft, Visa, TSMC, Amazon, Google, Meta, and ASML. All of these companies are near monopolies with very large economic moats and great long-term prospects. This is the second account. I have invested in several outstanding companies such as Apple, Google, Visa, TSMC, Microsoft, Nvidia, and Amazon. All of them are near monopolies that have great long-term growth prospects. Instead of selling them for quick profits, I am planning to hold them for many years so they can grow much more over time. This is the third account. It's much newer than the 2 other accounts, so it will take longer for these companies to become multi-bagger stocks. You can see that I have invested in Nvidia, TSMC, Amazon, Meta, ServiceNow, Microsoft, Google, Visa, Broadcom, Synopsys, AMD, Intuit Inc., NAM Research, Adobe, and ASML. My investing strategy is to always invest in the best companies that have large economic moats, great management teams, great products and services, great long-term prospects, increasing earnings, and increasing free cash flows over time. Then I like to keep buying their shares whenever they become undervalued. You may notice that I tend to invest in companies that are near monopolies with great long-term growth prospects. I tend to buy them only when they're undervalued to reduce risks. However, there's a downside to this strategy. The downside is that the best companies such as Google, Microsoft, Apple, Nvidia, Amazon, and Meta tend to get a lot of scrutiny from the antitrust regulators because they are near monopolies in their markets. As long as these antitrust cases do not affect their long-term business fundamentals, these market-leading companies such as the big techs that are near monopolies tend to perform exceptionally well over the long term. Let's go back to Google. These antitrust cases are the biggest headwinds or risk that are affecting Google right now. I believe they are only short-term headwinds. Let me explain here. Google is facing several antitrust cases from the antitrust regulators. These antitrust cases and claims will take at least several years to settle. The antitrust regulators allege that Google has a monopoly over the general search engine market, the online advertising market, and the mobile computing market. Here's the important part you should know. As one of the potential structural remedies, the DOJ is considering breaking up Google's businesses such as Chrome, Android, and even the Play Store. Of course, many investors are very concerned about this potential breakup. This is why Google stock has not fully recovered yet, even though Google's most important businesses such as search, YouTube, subscription, and cloud computing have been performing very well. I'm going to explain why I believe this breakup will not happen at all, despite all the negative news about these antitrust cases against Google. First of all, we have to understand that the antitrust regulators are targeting all the companies that are near monopolies in their markets, including Google, Apple, Meta, Amazon, Visa, and even Nvidia. The antitrust regulators are targeting Google the most right now because Google has the most services that are near monopolies. Just to give you a few examples, Google has dominated the general search engine market, having over 80% of the market for many years. Everyone uses Google because Google has the best search engine that's very easy to use. It tends to give the best and most accurate answers to user queries. It's in every mobile devices and every web browser, and is free for everyone to use. Google also has the best search algorithms, the most active users, the most advertisers, the most user data, the most web query data, and the most support from Apple, Samsung, and other popular web browsers. This is why it's nearly impossible for competitors to compete with Google in the general search engine market. Second, Google dominates in the web browser market. Google Chrome has had over 60% of the web browser market for many years already. And third, Google also has the largest market share in the mobile OS market. Typically, when you buy a smartphone, you only have two choices. You can buy an iPhone from Apple or buy an Android phone from Samsung or other phone makers. Here's one of the biggest issues right now. Google has exclusive agreements with Apple and Samsung to be their default search engine on their devices and services. Under these exclusive agreements, Google has been paying Apple more than $20 billion each year to be the default iOS search engine. This is essentially free revenue for Apple each year. Google has also been paying billions of dollars to Samsung, Firefox, and other popular web browsers to be their default search engine. Let's think about this. Apple, Samsung, Firefox, and all the major companies that have exclusive partnerships with Google are incentivized to let Google be their default search engine because they will continue earning millions of dollars or even billions of dollars of shared advertising revenues each year. Other search engines such as Microsoft Bing, Yahoo, and DuckDuckGo cannot generate the same amount of advertising revenue as Google, so it's nearly impossible for other companies to compete with Google in the search market. This is my prediction. Instead of breaking up Google's businesses, I believe the antitrust regulators will not allow Google to have exclusive agreements with Apple, Samsung, and other companies. This means users will be prompted to choose their default search engine whenever they use an iPhone or an Android phone, or whenever they use a web browser. If this is the case, I believe most people will still choose Google to be their default search engine instead of choosing Microsoft Bing, Yahoo, ChatGPT Search, or other AI search engines because Google simply has the best search engine that is very easy to use and is free to use. Google has several ways to counter these antitrust cases. First, Google will face a lot more competition from ChatGPT Search, Perplexity AI, Meta AI Search, and other AI companies that are making their AI search engines. Going forward, Google may lose some market shares to these new AI search engines, especially ChatGPT search or Perplexity's AI search engine. Second, there's an ongoing tech war or AI chip war between the US and China. This AI arms race will last for many years. Both the US and China want to be the market leader in AI, advanced chip manufacturing, advanced chip design, cloud computing, mobile computing, and other leading-edge tech. I believe the US antitrust regulators will not break up Google's businesses because Google is too important in AI research and cloud computing. Breaking up Google's businesses will make the US less competitive in AI research and cloud computing compared to China. The US wants to be the market leader in AI, advanced chip manufacturing, advanced chip design, cloud computing, and other leading-edge tech. Google is already one of the market leaders in AI and cloud computing, so it will not make sense for the US to make Google less competitive in AI and cloud computing compared to other Chinese AI companies such as Alibaba, Baidu, Tencent Holdings, and ByteDance. Now, similar to the Microsoft versus the DOJ antitrust case from the late 1990s, Google's biggest argument is that these antitrust allegations will stifle the success of domestic firms, meaning Google and the big tech companies in the US on a global level, hence making them less competitive compared to the Chinese companies that are also competing in AI, cloud computing, advanced chip design and manufacturing, and other leading-edge tech. Instead of breaking up Google's businesses, I believe Google's settlement will be similar to the Microsoft versus the DOJ antitrust settlement in 2001. Google will likely need to end exclusive agreements with Apple, Samsung, and Firefox. Instead, users will be prompted to choose their default search engine whenever they use their smartphones and web browsers. Of course, most users will still choose Google as their default search engine instead of choosing Microsoft Bing, Yahoo, and other AI search engines. Also, Google will likely need to pay hefty fines because of anti-competitive behaviors. Let me show you these latest financials here. I believe Google has a very strong balance sheet. For example, the most recent financial reports show that Google had around $93 billion in cash equivalents and marketable securities. In comparison, Google had around $24 billion in long-term debt and operating lease liabilities. This means Google can pay off its long-term debt and operating lease liabilities in advance and still have nearly $70 billion cash left. If Google needs to pay billions of dollars in fines, it will not be a problem because Google already has more than $90 billion in cash equivalents and marketable securities. In terms of past financials, Google has had very consistent revenue growth, operating income growth, operating margin growth, and free cash flow growth over the past 10 years. Going forward, Google is planning to increase its capex in AI infrastructure to meet customer demand. I think we can expect that Google's free cash flow will likely dip this year and next year. Let's talk about Google's long-term growth prospects and the biggest growth drivers over the next 5 to 10 years. I believe Google has 3 major growth drivers. The first biggest growth driver will still be Google's most important businesses, Google Search, YouTube, and Google Network. These businesses have been generating the most advertising revenues, net profits, and free cash flows for Google for many years already. This will continue to be the trend for many years, but their revenue growth rates will likely slow down going forward because their businesses are already very mature. Going forward, if I have to make an educated guess, I think Google advertising will likely grow at high single-digit rates or low-teen rates in most years. The second biggest growth driver will be Google's subscription, platforms, and devices business. This includes YouTube Premium, YouTube TV, Google One Premium Plan, and Android apps. According to management, YouTube's total ads and subscription revenues have already surpassed $50 billion over the past 4 quarters for the first time. Of course, YouTube's advertising and subscription revenues will grow much more over time because more people will continue watching YouTube videos. Creators will continue creating more YouTube content, and more people who don't like ads will sign up for YouTube Premium. The third biggest growth driver is Google Cloud. I believe Google Cloud will be a very large growth driver for Google going forward, similar to how AWS has become the largest profit driver for Amazon. For example, according to the latest financials, cloud revenues increased 35% year over year. In comparison, Google Services revenues grew 15% year over year. Of course, Google services such as Google Search, YouTube, Google Play Store, and subscription services will still generate the most profits for Google. However, I expect that Google Cloud will become much more profitable over time, similar to AWS. For example, in the most recent quarter, Google Cloud had an operating margin of 17%. In comparison, Amazon Web Services or AWS had an operating margin of 38% during the same quarter. Here's the deal. Similar to AWS, once Google Cloud scales more, has more GCP customers, and offers more AI computing and storage services to GCP customers, Google Cloud can spread out its fixed costs and improve its operating margin over time. At the time of making this video, there's still a huge shortage of AI compute that is needed to train and infer AI models and AI applications. The demand for AI services and AI applications is much higher than the supply. All the major cloud providers and tech companies such as Amazon, Microsoft, Google, Meta, and Oracle are planning to increase their capex on AI infrastructure because they need a lot more AI compute, storage, and AI systems to meet customer demand. Here's the deal. Contrary to what the market initially believed, the largest cloud companies are already generating higher returns on their AI investments. This is why they're planning to increase their capex on AI infrastructure much more in the upcoming quarters. Of course, Nvidia will continue to benefit the most because most of these capex will be used to buy Nvidia's latest AI supercomputers in the upcoming quarters. This from Investopedia. Microsoft CEO Satya Nadella said the company's AI business was on track to reach an annual revenue run rate of $10 billion in the current quarter, making it the fastest business in our history to reach this milestone. Jesse from Amazon said Amazon's AI business is growing by triple-digit percentage, 3 times faster than cloud computing grew in its early stage. Alphabet's management said that they expected AI investments to translate to revenue in the fairly short term. AI overviews in Google Search were being monetized at approximately the same rate as older formats, boosting confidence that AI can boost Alphabet's core ad business as well as its cloud units. As for Meta, Mark Zuckerberg said AI-driven feed recommendations had increased the time users spent on Facebook and Instagram this year, and that businesses using Meta's generative AI advertising tools has seen an increase in conversions. Here's another AI security trend that is benefiting Google now. Google has been using AI to generate new codes. This helps Google improve employees' productivity and lowers hiring costs. According to Google CEO Sundar Pichai, today more than a quarter or 25% of all new code at Google is generated by AI, then reviewed and accepted by engineers. Here is another important part of Google's cloud computing business. This is one of Google's biggest competitive advantage. Google has been making its custom AI chips called Tensor Processing Units or TPUs much earlier than Amazon and Microsoft. This gives Google a very large cost advantage compared to Amazon and Microsoft because Google has been using its own custom TPUs to train its Gemini AI models instead of using Nvidia's AI GPUs. This is why Google Cloud's operating margin has improved a lot in recent quarters. Google uses its TPUs internally for AI training and the development of AI applications. Google also rents its custom TPUs to Apple and other AI developers each year. This allows Google's largest customers, such as Apple, to save a lot of money on capex each year because it's very expensive to invest in Nvidia's AI GPUs and AI supercomputers that are needed to train and infer AI models and AI applications. Here is another growth catalyst for Google Cloud. According to Oracle's Larry Ellison, it costs about $100 billion to build a frontier AI model over the course of 4 to 5 years. Very few companies in the world can afford to invest billions of dollars and have the AI expertise to develop the best foundation AI models. Google is one of the few companies that have the capital and AI expertise to build the best foundation AI models. To stay competitive, Google will continue releasing newer AI models such as Gemini Ultra and Gemini Pro. These latest AI models will continue driving more cloud revenues for Google Cloud going forward because many AI developers will use Google's latest AI models to build their AI applications. Let me show you this cloud provider market share here. As you may already know, the largest 3 hyperscale cloud providers, Amazon, Microsoft, and Google, have dominated the cloud infrastructure services market for many years. According to the most recent data, these 3 largest cloud providers own about 64% of the cloud infrastructure service market. Going forward, the entire cloud infrastructure services market is expected to accelerate again over the next several years because of the very large demand for AI services, foundation AI models, and AI applications. Amazon, Microsoft, and Google will benefit the most because they have the most AI compute and storage that they can rent out to other AI companies that want to develop their AI models and AI applications. It's very expensive to buy the best AI accelerators and AI supercomputers from NVIDIA, so most AI companies will need to rent AI GPUs from the largest cloud providers such as Amazon, Microsoft, Google, and Oracle. Here is another trend that I believe will benefit Google going forward. According to IDC research, IDC has forecasted that worldwide spending on public cloud services is expected to double between 2024 and 2028. During this period, the public cloud services market is expected to achieve a 5-year compound annual growth rate or CAGR of 19.4%. There are two main growth drivers. First, large enterprises and government agencies will continue moving their IT infrastructure to the cloud. Second, as I mentioned earlier, the very large demand for AI applications across many industries will increase the demand for public cloud services. This is from Google's most recent earnings call. Management talked about Google Cloud's higher than expected growth, why Google Cloud is becoming more efficient than before, why AI is already transforming Google and generating high revenues for Google, and how Google's custom TPUs are benefiting the company a lot. Management said this.
We are also doing important work inside our data centers to drive efficiencies while making significant hardware and model improvements. For example, we shared that since we first began testing AI overviews, we have lowered machine costs per query significantly. In 18 months, we reduced costs by more than 90% for these queries through hardware, engineering, and technical breakthroughs, while doubling the size of our custom Gemini model. And of course, we use and offer our customers a range of AI accelerator options, including multiple classes of NVIDIA GPUs and our own custom-built TPUs. We are now on the 6th generation of TPUs, known as Trillium, and continue to drive efficiencies and better performance with them. We're also using AI internally to improve our coding processes, which is boosting productivity and efficiency. Today, more than a quarter of all new code at Google is generated by AI, then reviewed and accepted by engineers. This helps our engineers do more and move faster. We are well positioned because in our AI infrastructure, we have a comprehensive solution set, right? We have all the leading AI accelerators, GPUs, TPUs, as well as CPUs, and we are investing in all of them. We have a wonderful partnership with NVIDIA. We are excited for the GB200s and will be one of the first to provide it at scale. On the TPU front, I think we have not only are we in our 6th generation, I just spent some time with the teams on the roadmap ahead. Couldn't be more excited at the forward-looking roadmap, but all of it allows us to both plan ahead in the future and really drive an optimized architecture for it. And I think because of all this, both we can have best-in-class efficiency, not just for internal at Google, but what we can provide through cloud. And that's reflected in the growth we saw in our AI infrastructure and Gen AI services on top of it.
And as you think about them, we offer both GPUs and TPUs, both internally and to our customers. So we have choices and options based on what our customer needs and what our internal needs are. And as you think about the next quarter and going into next year, as I've mentioned in my prepared remarks, we will be investing in Q4 at approximately the same level of what we've invested in Q3, approximately $13 billion. And as we think into 2025, we do see an increase coming in 2025, and we will provide more color on that on the Q4 call. Likely not the same percent step up that we saw between 23 and 24, but additional increase.
The one other thing I would add on Doug, on your first part of the question on the TPUs is, if you look at the flash pricing we've been able to deliver externally, I think, and how much more attractive it is compared to other models of that capability, I think probably that gives a good sense of the efficiencies we can generate from our from our architecture. And so, and we are doing the same that for internal use as well. The models for search, while they keep going up in capability, we've been able to really optimize them for the underlying architecture, and that's where we are seeing a lot of efficiencies as well.
Thanks. I have one for Sundar. Sundar, there was this perception, and even false, that Alphabet was not as innovative on AI as they should, and it clearly shows that that was wrong. You're moving pretty quickly, rolling out new products. Can you talk a bit about how you may have changed the org structure? I know you've combined some assets, but talk a bit about how you maybe rethought how you go to market with some of your innovation products, and maybe what's changed operationally as AI has picked up steam for you guys.
Thanks, Michael. Look, I definitely think it's an extraordinary opportunity, and I think the company, given the important moment, we had to gear up to build models from scratch that could be productionized at scale, on our architecture, and that's what the Gemini era was about. So there was a fixed cost of getting it all set up and getting the Gemini era underway. But now I think we are in much more of a virtuous cycle with a lot of velocity in the underlying models. We've had 2 generations of Gemini model. We are working on the 3rd generation, which is progressing well. And teams internally are now set up much better to consume the underlying model innovation and translate that into innovation within their products. So now, all the 7 products which have 2 billion users each have done their first versions of incorporating Gemini, and there is aggressive roadmap ahead for 2025.
Let me show you this consensus forecast from Skin Alpha. Google's revenue is expected to grow between 10% and 13% each year over the next 5 years. In comparison, Google's EPS is expected to grow slightly higher at low teens or mid-teens each year over the next several years. I think these EPS growth rates are reasonable because Google's operating margin will likely improve over time. In terms of valuation, Google's forward PE is expected to be around 21 this year, which is very low for a mega cap growth company. Google's forward PE is expected to be around 19 next year. This is still exceptionally low for a mega cap growth company. Based on these forward PEs and expected EPS growth rates, I believe Google is still undervalued now. Let me show you this investing software I'm developing with a friend. This is a preview. Google's fair value is the orange line here, and the stock price is the blue line here. The green line is analysts' average price target over the next 12 months. At the time making this video, Google is traded below its fair value line by a small margin. I believe this suggests that Google is slightly undervalued now. As I mentioned earlier, I did buy more Google shares during this large dip here. Let me show you this intrinsic valuation model here. I always use this intrinsic valuation model to calculate each stock's intrinsic value. You can use it to calculate Google's intrinsic value, so you will know when Google stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Google's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 10% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe Google's value will grow between 12% and 13% this year. After that, I believe Google's revenue will grow at a compound annual growth rate or CAGR between 10% and 12% each year over the next several years. This is very close to the consensus revenue estimates. I used a long-term growth rate of 6.5% to calculate the terminal value. I think this is already very conservative for a big tech growth company. If you want to be more conservative, you can use a lower long-term growth rate to calculate the terminal value. This year and next year, I'm assuming Google's free cash flow margin will be lower than the past few years because Google is planning to spend a large amount of capex on AI infrastructure. However, I believe Google's free cash flow margin will still improve gradually over the longer term. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we forecast that Google's revenue will grow by around 12% this year. After that, we forecast that Google's revenue will grow at a CAGR of 10% each year over the next several years. Then Google's interest rate should be around 2.3 trillion for the entire company, or $185 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we forecasted that Google's value will grow by around 12.5% this year. After that, we forecast that Google's value will grow at a CAGR of 11% each year over the next several years. Then Google's interest rate should be around 2.39 trillion for the entire company, or $192 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we forecast that Google's value will grow by around 13% this year. After that, we forecast that Google's value will grow at a CAGR of 12% each year over the next several years. Then Google's interest rate should be around 2.48 trillion for the entire company, or $200 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Google's interest rate should be around $193 per share. I also used a 4 sales valuation model to estimate Google's interest rate, which should be around 2.09 trillion for the entire company, or around $168 per share. If we take the average of both valuation models, I believe Google's interest rate should be around $180 per share. In comparison, Morningstar has given Google a slightly higher fair value of $220 per share. This means I believe Google is still slightly undervalued at the time of making this video. So will I buy Google stock? Yes, I will continue buying more Google shares over time, as long as Google is still an outstanding business. I like to buy only when it's undervalued. I believe the US regulators will not force Google to break up its businesses because Google is too important in AI and cloud computing. The US is competing with China in the current AI tech war, which will last for many years. The US wants to be the market leader in AI and the most leading-edge tech, including cloud computing, so it will not make sense for the US to make Google less competitive. Similar to the Microsoft versus the DOJ antitrust settlement, I believe the antitrust regulators will make Google change some of its business practices and end exclusive agreements with Apple, Samsung, and other web browsers. This is my prediction. I believe most users will still choose Google as their default search engine instead of choosing Microsoft Bing, Yahoo, ChatGPT Search, and other AI search engines. Over the long term, I believe Google Cloud will eventually be the biggest growth driver for Google. This is similar to AWS, which is Amazon's biggest growth driver. Now, all these are only my opinions and my analysis that's based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.